Hi there, wondering how dividends and tax credits work in the UK? You know? Here's what shareholders need to understand for accurate tax reporting.
Welcome to Atlas Tax Advisors. We specialize in elite UK corporate structuring and tax compliance. Consider a common scenario. A director generates £100,000 in profit. They withdraw the funds, assuming dividend extraction remains highly tax efficient. 9 months later, they are hit with a massive, unbudgeted self-assessment bill. This shock occurs because the legislated rates and allowance thresholds governing UK profit extraction have changed for the 2026-2027 tax year. If you operate as the sole director of a small UK limited company, your extraction strategy requires immediate recalibration. The mathematical margin between trading as a limited company versus a sole trader has shifted, making the decision to incorporate more nuanced than in previous years. Withdrawing corporate cash is no longer a matter of informal estimates. Remuneration is now a strict mathematical engineering problem. The most pervasive misconception we see is the belief that dividends are tax-free because the company has already paid corporation tax on those profits. Before 2016, the UK operated an imputation system. Dividends were grossed up, carrying a notional 10% tax credit, offsetting personal tax liability. That system was entirely abolished. Under the modern direct assessment model, the tax credit vanishes, and the raw cash dividend is taxed directly. HMRC now evaluates your cash dividend without applying any corporate offsets to your personal tax bill. Despite the imputation system dying a decade ago, directors routinely miscalculate their liabilities by looking at modern dividend vouchers and assuming they retain historical protections. Relying on these outdated assumptions of built-in tax safety leads directly to a massive, unexpected personal financial liability. To build a modern strategy, we must define the new parameters. First, the tax-free dividend allowance has been compressed. In 2016, it was £5,000. Today, it is frozen at just £500. Second, the state increased rates by 2 percentage points. This threshold map outlines the 2026-27 dividend tax bands: 10.75% for basic, 35.75% for higher, and 39.35% for additional. Furthermore, a strict stacking rule applies. Dividend income sits directly on top of other income, like a base salary. Because your salary consumes the lowest tax bands first, your dividends are pushed higher up the scale, accelerating your trajectory toward that 35.75% threshold. With tax-free allowances heavily compressed and primary rates significantly hiked, preserving your corporate wealth now requires absolute precision in your profit extraction. Let's engineer the optimal hybrid strategy using a £50,000 extraction target, maximizing the basic rate band without spilling over into higher taxes. This cylinder is your income stack, bounded at £50,270. First, a $12,570 salary utilizes your 0% allowance, deducts corporation tax, and secures national insurance. Next, a £500 dividend allowance raises tax-free income to $13,070. The remaining £37,200 is extracted as dividends, taxed at 10.75%. If you attempted to extract this exact same amount purely as salary, the combined weight of employer and employee national insurance contributions would significantly reduce your net take-home pay. By mathematically stacking a $12,570 salary underneath basic rate dividends, you reach the absolute ceiling of tax efficiency for a sole director in 2026-27. While that model represents optimal efficiency, attempting to artificially stretch these mathematical limits using improper structural changes will now trigger severe scrutiny. Historically, family businesses used alphabet shares, creating A, B, and C share classes to route disproportionate dividends to lower-earning spouses. The reporting gap that allowed these distributions to go unnoticed has been closed. HMRC has instituted a new, aggressive data gathering mandate. Starting in the 2025-26 reporting regime, directors of close companies must explicitly disclose their exact percentage of share capital directly on their self-assessment returns. This targeted data allows HMRC algorithms to instantly cross-reference your stated shareholding against the dividend payments you receive, automatically flagging disproportionate payouts. Structural tax manipulation via shares is now highly visible on the state's radar. Attempting aggressive income shifting without rigorous professional justification operates as a direct audit trap. There is a second major compliance trap: declaring dividends when the company lacks the actual post-tax distributable profits to support them. Legally, a company cannot distribute cash it hasn't earned. When this occurs, HMRC will reclassify the illegal dividend as an overdrawn director's loan. Looking at this flowchart, we see the legal consequence. A rejected dividend payment routes directly into a Section 455 corporate tax penalty box. Because this rate is tethered to the dividend upper rate, the penalty automatically spikes to 35.75% for 2026-27. Extracting this unbacked cash instantly transforms a standard 10.75% personal tax obligation into a massive punitive 35.75% corporate charge. The parameters for 2026-27 are unyielding. The historical tax credit is dead, the dividend allowance remains frozen at £500, and the primary rates sit at 10.75% and 35.75%. For most sole directors, establishing a $12,570 salary base and topping it with basic rate dividends remains the most mathematically sound path for corporate extraction. However, the margin for error is razor thin. Navigating the new alphabet share reporting rules and avoiding Section 455 traps requires bespoke modeling based on your specific profit levels. This briefing is for general informational purposes only and does not constitute financial or tax advice. Tax legislation is complex and subject to change. To protect your corporate wealth, contact Atlas Tax Advisors today to arrange a personalized remuneration review for the current tax year. With allowances shrinking and algorithmic HMRC scrutiny increasing, precision, not assumption, is the only way to safeguard your profits.